All of those news stories all packed into one show on India Tonight. First, we're talking about the markets where the bulls have fought back today and have taken the Nifty above 21,200 at the end of trade. In fact, the benchmark index has jumped 1.3% from the kind of lows it hit during intraday trade. And today, the kind of up move has been led by the likes of HDFC Bank and Reliance. But let's get a deeper understanding of what went down in trade today. And for that, my colleague Anisha is with us. Anisha, how did we do after the kind of sharp fall that we saw in the markets today? We've seen recovery, haven't we?
Well, the market headline for today was clearly the recovery. That's the big theme, because if you look at the headline index, we managed to gain almost 1% above the mark of 21,200 comfortably. We started completely on the back foot, and since there was only a one-way move that really happened. But the bigger recovery today was in the broader markets. The small cap index recovered almost 4% from the lowest point of the trading session, and the mid cap index too piled on gains of almost 1,400 points in an intraday basis. So that's the kind of solid recovery that we saw. Even the banking index, for that matter, recovered almost 800 to 900 points by the end of the day, and the move for the banking names today was led by some of the large private banking names. Case in point being HDFC Bank. That was one of the heavyweights that was really participating today. You also had other names like Kotak Mahindra Bank doing well, and some of the public sector names like Central Bank, SBI also participated. From the frontline index, it was also Reliance that batted for the bulls, so that name definitely came up on the radar. On the losing side, however, it was a bit of a curious case of weakness in Axis Bank and ICICI Bank, and some of the other names were too coming under pressure. From the broader markets, a lot of those IT names were doing well. Cyient, for instance, Zensar Tech. There was also that platform company RateGain that managed to gain almost 7 to 8% by the end of the day. So there have been a lot of individual movers today. In terms of news flow, it was Z Entertainment which was reacting to the news flow of no formal extension, but still at least the hope being alive, and then of course a few brokerage reactions and such. But overall, it was a good trading session coming in for the Indian bulls, ending in the green.
Yes, indeed, quite a recovery, and thanks for that, for walking us through today's market session. But of course, when you talk about the correction, it was not totally unexpected. The correction was sharp. The markets have still recovered today, and should this be a surprise or not? After all, these are signs of a typical bull market, is the editor's take. Here it is.
So I'm not at all surprised that markets have corrected, and if markets would have not corrected, that actually would have added to froth, and that would have led to a bubble creation. Now, why did market fall yesterday? You cannot specify it to a particular reason, but say that there was profit booking, and there was massive profit booking, and the reversal, I think, is reminiscent of what we see in a bull market, which is that it is very sharp, it is very severe, and before you realize that the correction has kicked in, the correction actually would get over. There was no trigger, both locally and globally, which really ignited this selling. So that means that it was technical in nature, that means it was local in nature, and that means that it really smacks of profit booking.
The kind of correction we've seen smacks of profit booking. That's the editor's take. Let's find out what independent market expert Mahantesh Sabarad makes of this. What's your reading, Mahantesh? The kind of fall we saw on Wednesday, the recovery today led by banks, IT and auto stocks. What do you put down as the reasons?
I think to some extent, Nikunj is right by saying that it was a bit of a profit booking that can be seen. But also, we should remember that there is some news building up related to the COVID cases. Once again, probably there is a concern that is now growing in the market. So that said, profit become therefore when such risks arise, when you are sitting on huge profits. Mind you, the mid cap, small caps for the year are up close to 50% odd. So profit booking is nevertheless due. And if there are concerns that are coming up, it always makes sense to book profits and take away the gains that you have made.
Typically talk about mid caps and small caps. Do you see more volatility in the markets because some of those valuations would be stretched in the broader markets, and corrections like yesterday should be expected, you think?
To some bit of the rally that we saw in small cap and mid cap was thanks actually to the base effect going away. We had corporates actually struggling, particularly on the small cap and the mid cap side, struggling with raising their profitability, raising their overall revenue pie. This year has been that year where the base effect having gone, now they are better poised for growth ahead, and therefore valuation was not a challenge when we saw this the indices run up 40-50%. They didn't really challenge the valuations in certain companies because the growth was there, and there seems to be a case that says that the growth will further continue because the capex has been also particularly good for most of these companies. Capex obviously brings in more revenues in the year ahead. So an analyst or the market can forecast better revenues, better profitability going into the new year. There are other macro tailwinds that also help these valuation gains. You had a rate pause, particularly from RBI, and to some extent a similar rate pause that came in from the Fed. That helped in terms of the tailwinds for the equities to really do well. So I'm not surprised by the gains that we saw, but valuation, like I said, wasn't a challenge when this buildup was happening.
Yields in India and the US, Mahantesh, they have eased, and the 10-year American bond yields have touched their lowest level in almost 5 months, now at 3.85%. The chances of early interest rate cuts by the Fed, they look pretty strong. So how do you expect Indian markets to move ahead of that cue? And if at all you can tell us how you think investors should position their portfolios to make the most of it?
So when you have the Fed now poised to either drop interest rates or cut them quite aggressively now, given the gap between the current policy rates and the 10-year yields, then you will have a situation where the market becomes more hungry for risk. So they are poised to take on more risk. Typically, emerging markets and particularly India, therefore, becomes a great opportunity for the risk takers to visit in terms of their investments or broaden their investments overall, and that helps the overall portfolio situation. It obviously will mean that we will have a lot of FII money coming in. As it is, we have the domestic participation being very strong in the equity market. So, therefore, uh, once again, I will say that given the corporate profitability growth and the money that is coming in, valuation for the risk, the taking ability that most people, more funds will have, will mean that we will have higher markets ahead as well.
In the structural growth story, when you talk about the Indian markets right now, it does seem strong, and in a bull run, like you also agreed with the editor, that we are bound to see this kind of sharp correction from time to time. We'll see exactly how it goes from here. But thanks very much, Mahantesh. As ever, it's a pleasure speaking to you and speaking to you about the markets.